we are on the next edition of our Conversations with Capita, and very interesting topic that we'll be discussing today. At Capita, we generally talk about all equity matters, but today I think we are veering away a little bit from that equity territory to now talk about beyond equity and how can startups and founders leverage debt as an instrument effectively. Perhaps this topic becomes even more relevant, I think, given the current funding environment where there's a larger push to become profitable, generate cash flows, and debt becomes a very credible instrument, I think, where you can power your company's growth. And we have Amar Ummat with us to decode that for us. Amar Ummat is the founding partner at Recur Club, who's a close partner to us, and he'll help us decode some of these questions we have on how can startups, founders, leverage debt or non-dilutive forms of instruments, funding instruments for their growth. So Amar, welcome to this conversation. How are you doing?
Srikanth, thank you so much for having me here. I'm doing very well. I hope everyone who's listening us also is doing well and having a good day. But thank you so much. Excited to be here and run through the questions that the forum has, and generally decode, as you mentioned, how exactly can various forms of capital, which include debt and equity, can be stacked up to really create that efficient capital stack.
Exactly. And exactly. I think we're calling it also debt with equity, right? So we are also assuming that, every company needs to have an efficient capital structure, for various purposes, to drive their growth. And yes, that's exactly what we will decode. I see there are a lot of people tuning in and sending out messages. So yes, let's keep this conversation interactive. So feel free to keep adding your questions as we go along, and I'll try to bring them up. I have a few questions as well that I'll run through, but any other contextual question is something we can take up, something else we can always take it towards the end, right? So Amar, first things first, right? You're part of Recur Club, and I just Googled, I went to your website to get a quick definition of what Recur does, and I think you offer what you call as fast, flexible, transparent and non-dilutive capital. I hope I got the adjectives right. And at every stage of company's growth. So can we decode this to begin with, right? So maybe a quick description of what you guys do, and then we go on from there. So over to you.
No, absolutely, Srikanth. I think that will be a great sort of place for us to start for the benefit of everyone. As Srikanth introduced, I'm one of the founding partners at Recur Club, and our entire thesis was built around non-dilutive capital when we started. The idea that we wanted to bring to the entire ecosystem was that there were traditional ways of raising capital. There was equity dilution that you could have always gone down the road of, and there were traditional debt instruments that were maybe inaccessible to most, and hence democratizing this entire financial landscape is why Recur got created. What we primarily do is we are a technology company very similar to yours, Srikanth, at Capita, where our entire aspect is working with companies that can not only just take debt, but utilize debt to really grow their capital stack to a place where their capital stack is really working for them. Hence, solving for inefficiencies in the market, which we believed are the primary use cases, and we were taking multiple founder feedbacks when we were speaking with the market, trying to identify what is the problem. It really came up that traditional lending is extremely time consuming. Traditional lending is not transparent. Traditional lending is full of restrictions and covenants. And that is what we wanted to really decode, that the financial landscape has evolved, our lenders have evolved, and there is a way that the paradigm shift from the lenders to the borrowers can be done. And that is what Recur really facilitates. So in a single line, all the adjectives that you used were absolutely apt. Those are the ones, use cases that we had identified, and are the use cases that we solve for when we are not just facilitating, but advising companies on how exactly to utilize the debt to create a growth map and a growth trajectory for themselves.
Perfect, Amar. That's a great start to this whole decoding part, and great description of what Recur does. Definitely, I think a lot of founders I talk to, and that was actually my next question, right? Like a lot of founders we talk to, it's very challenging for them whenever they want to consider debt. Right, and the constant complaint is, the debt is inaccessible, and perhaps rightfully so at some of the very earlier stages, because without cash flows or revenues, it becomes difficult to service. So first question, maybe Amar, now taking a company's journey into consideration, of when should a founder consider exploring debt or any kind of non-dilutive returnable form of capital as an instrument for financing their growth? Yeah.
Yeah, absolutely, Shrikant. I think a very relevant question. This is one of the most predominant questions in the ecosystem that even generally we face. So I have a tendency, Shrikant, just to sort of put it out there, of switching between Hindi and English, and I know that our audience is sort of scattered across. So please do stop me in case I move towards the Hindi aspect of my discussion. But yeah,
Yeah, maybe
coming back to the question.
we can aim to use predominantly English, but yes, I think
Most
wherever the
definitely.
essence in Hindi, that's fine as well.
Yeah, yeah, absolutely. So, Shrikant, I think the most important aspect here is that debt as an instrument, right? We, at any point of time when we really look at fundraising or we're really looking at raising capital, we really also need to identify that why are we really using or rather going down this path of raising capital. At any point of time, if you are raising capital, it also comes with the responsibility of deploying this capital. If you are not being able to deploy that capital, then it primarily means that you did not really have an identified use case due to which you have gone down this particular path. Now, debt as an instrument, as you and our entire audience will appreciate, does not really generate equity like returns, which means that it is not fair for an instrument like debt to take equity like risk. At any point of time when a company is in its earlier ideation stage where there is no cash flow, where there is a PMF or product market fit for the benefit of everyone being evaluated, where they are still pivoting to find the right customer, or for that matter, if they found the right customer, the right problem statement, they don't really have cash flow streams that they can rely on. The moment we talk about non-dilutive, there needs to be something which is helping a company raise capital and yet secure when you think of it from a lender's mindset. So in the phase of a journey, and this is where I'll actually enter into another sort of aspect across the 500 companies that we work with. It depends on what journey a founder or the team really is in, right? If you are in the 0 to 1 journey, you will be iterating. In the 0 to 1 journey, the strategy is generally land grab. You need to hear a lot of customers. You need to be able to move at the speed of light. You need to be able to experiment, ideate, iterate, and then be able to solve for these use cases. Now, what happens is when you're looking at all of these aspects, they have a slight aspect of unpredictability associated with it. And the moment unpredictability comes into the picture, debt becomes a less attractive instrument. However, in a phase where a company moves from, let's say, 0 to 1 to 1 to 10, where they believe that they have now identified the right customer, they have also identified potential use cases that they are solving for and started receiving feedback, they need to enter into a phase where R&D comes into the picture, where customer retention comes into the picture, where working capital gaps come into the picture. And that is where debt really plugs in the gap. Traditionally, what we have been seeing companies do is no matter what the end use case was, equity was most attractive and most accessible in the market, right? Till the so-called VC winter came and affected all of us. Equity was available abundantly. And also, I apologize if there's some background noise. Please do tell me if there's some background noise behind me.
Oh,
Yeah.
we are
So the
good, yeah.
moment Wonderful. So at any point of time, while they were raising equity, because it was so accessible and easily, readily available, they were taking it. But that's not the right way of using it, right? Because you have finite equity. Yeah? All of us, when we started, we have only 100% of that company. The more I keep diluting, the more I lose control of my company, the more I lose the ability to take decisions. Hence, that 1 to 10 journey where there is a cash flow stream, which is predictable, which is either recurring in nature, or for that matter, at least has some amount of surety that it is going to come into your business, can really be leveraged to take and create more debt-like structures or predictable debt products.
Right.
Obviously, as you scale between 1 to 10 and then move into the 10 to 100, or let's say 100 to 1000 kind of a journey, which is the pure scaling, you build credit worthiness, you build your ability to become more credit worthy for the lending ecosystem. And that is where taking debt in 1 to 10 is not just solving for working capital gaps, it's not just solving for immediate growth capital needs, it is also solving for credit worthiness, which will be required when you need to maybe create a debt line of X number of crores, right? And to create an X number of crores deadline, you need to be able to create credit worthiness. So all of these aspects really come into the picture, Shrikant, where depending on the
Right.
life cycle of a company, and more than the life cycle of a company, I will reiterate on the statement that I just made, which is identified use case for which capital raising is required, is where debt and equity can either be complementary or compete with each other to come into a capital stack.
Right. No, I think very valid point, and kind of you answered the next question also I had was the why. I think when is completely addressed. There should be definitely a sense of predictability again, it's something you need to service. It's not as flexible as an equity, where you can give returns to your shareholders over a long period of time. Whereas debt is where I think there is some liability to pay out at regular intervals in some sense. And the next question was actually on the why. I think you kind of touched upon it already, that equity is in a way the most commonly used instrument. You mentioned about how it is being prevailing. I think we are sitting on the largest record amount of capital as an ecosystem that we have raised, taking the Indian VCs into consideration. I think you made a very good point that to prepare yourself to get debt as a streamlined asset class later on. I think taking baby steps towards using stakeholders like you, right? So does that mean that you also work with a lot of early stage companies and maybe plug that gap between someone obviously making revenues but not still kind of accessed by banks? Is that the sweet spot you look at?
Yeah, most definitely, Srikanth. I think that is one of the use cases that we solve for again when we are working with companies. But before I actually get into that, I wanted to also answer the why part from a more quantitative standpoint. While I did give a qualitative answer for the benefit of everyone,
Right.
it is very important that when you are building a capital stack, right? Uh, it will again go down to the speed of deployment and the rate of return on deployed capital that you can really earn. It is extremely important that at no point of time when you are taking debt, it is eating into your bottom line. Keeping all of this in mind, if I have taken debt today, let's say at X percentage, right? Because as everyone will appreciate, debt comes with its bells and whistles. You have to service cash flows on a regular basis. And if I'm, let's say, paying 20% on debt that I have taken, I need to know that I have the ability to at least generate 21% as return on deployed capital. And hence, I need to use debt only in those identified places, maybe hiring, maybe in inventory purchase, something where the payback period can be calculated. And that payback period, for example, in a 12-month loan at a 20% interest, can I generate 21% rate of return on this deployed capital over 12 months? Now, if I can do this, then I know for a fact diluting my equity will, plain simple, in absolutes, in normal English words, be foolish, right? Because if I am being able to service a project and I'm going to get the revenue for it, then I will always be evaluated by VCs, by private equity funds, by family offices as a multiple of my revenue. So if I can grow my revenue and I can really make my revenue more robust and I can keep cycling debt for it and then dilute my equity at a later stage, it is a far more prudent way of really building a capital stack. So that is more on the why when I am taking it. To answer the second question, Shrikant, that you had, that what kind of companies do we really work with? I think it will be helpful for me to also very quickly tell you the general criteria that we have observed in the market across the 600 plus companies that we are working with. If a company has a typical vintage of about 1 year and has annual recurring revenue, and I know there are various ways that founders really calculate ARR. Some look at MRR into 12, some look at quarterly revenue multiplied by 4. But yeah, if you have an annual recurring revenue of about 1 crore and your cash runway position, it is very, very important for me to keep specifying and using this point, which is cash runway position, because it's only free cash that can service debt. If these 3 or 4 criteria really meet, then you are attractive to some form of debt. There is some form of debt that is available and sustainable. And that is where, Shrikant, the majority of the companies that you mentioned right now really come in, where they have a vintage, where they have just about enough ARR and about 5 or 6 paying customers, where they don't really need a lot of debt on their balance sheet, but they also need advice on how to utilize this debt so that the burden of debt does not really make the company dissolve. So that is why when we work with companies that are in the early stage of their life, of their own company life cycles, it is on facilitation as well as use cases where they can deploy this debt to really grow their capital stack.
Got it. No, that's helpful. I think we've also got some questions. So I think Harsha asks, in the stage of 1 to 10, and this is a very valid concern, right? Doesn't debt add as a financial burden to the finances? I mean, the cash flow of the company. So I think maybe it's also good for you to define, and in a way you defined the criteria just now. So what is really 1 to 10? Because I think everyone will have a different definition of 1 to 10. For many, 1 to 10
Yeah,
is
no,
still a
most
very
definitely.
formative stage of the company, right? Yeah. Yeah.
So quite a few theses exist in the market that what exactly qualifies as 1 to 10. Yeah, some in the ecosystem generally, when we are speaking and just sort of hearing a lot of conversations, some say that product market fit is achieved when you reach a $1 million kind of an ARR. If you have been able to achieve $1 million of ARR, then and have at least X number of paying customers, then you are in your 1 to 10 journey, where you have to think about the scaling mindset and let go of the building mindset. Certain other ways of looking at the 1 to 10 journey is that your retention of your customers over a particular period of time is almost 100% or above 95%, which means that the paying customer is paying you for a service or an identified problem that you're solving for them. So in this particular question, Harsha, that you really asked, I believe that debt can be maximum leveraged in the 1 to 10 journey, because what happens is there are various forms of debt that really come into existence, right? I do understand your question that burdening a balance sheet also happens with debt, but that is only if it is not well planned debt with an identified use case where you want to deploy it. For example, and I'll take a very standard example, right? If you have a paying customer that is paying you 100 rupees month on month, you know for a fact, based on the vintage of this customer, that this customer is going to allow you to earn a revenue of 1200 rupees, but you have to wait for 365 days to make this 1200 rupees. Now, in business, and this is always a problem that comes up, cost is always front ended and revenue recognition is back ended, and hence working capital gaps really come into existence. So if debt can plug this gap where your future revenue can be advanced to you at a discounted price, which is anyway a concept that a lot of SaaS founders in our audience, in case they are there, would be understanding, that they self discount their revenue, eroding their top line just to raise capital in advance. If this can be done via debt, then it actually facilitates you to maybe experiment with debt in that 1 to 10 journey. And it also allows you to, one of the things that I very commonly speak with most of the folks about is that when you pivot from 0 to 1 to 1 to 10, in 0 to 1, you need to listen to every customer. You need to listen to every voice that is there on the market. You need to be aware of what they are saying to be able to build your next feature. However, in 1 to 10, maybe you need to move away from your loudest customer to your most passionate customer, because those passionate customers are the problem statements for which you want to solve for, and they are the ones that you want to scale with. And hence, again, debt really comes as a very important instrument, because you know this customer is going to pay you. Take an advance on their cash flow, use that to build the R&D, build the features that this customer wants, and then scale with them in this journey.
Right. No, that's very helpful. So I think the bottom line is, and maybe to Harsha's question, that you still take debt, when there's a stability of the cash flows, when the revenues are more predictable, like the example. But I think the examples also you're taking, Amar, is it what you guys are building and offering? Is it more relevant for like SaaS kind of companies? With you also mentioned recurring revenue, and hence your name Recur, I guess, as well, right? So is that the typical range of companies you cater to, or no? That will be great if you can get into that. Yeah.
So Shrikant, that actually sort of was how we started, but very soon we realized that recurring revenue can actually be extended into another concept called reoccurring revenue. And the only difference between recurring revenue and reoccurring revenue is one is contractual and one might not be contractual, but has definite predictability to it. So at any point of time, if there is a predictable cash flow, if there is a rolling cash flow or a recurring cash flow or a reoccurring cash flow, you are being able to obtain debt, because all of this is coming with a sense of predictability to it. So while SaaS companies, it fits very, very well, because there is some aspect of revenue recognition happening over a particular time period, even for reoccurring revenue companies. And what I mean by primarily this is, for example, there could be a staffing or a recruiting company that we're talking about. There could be a company where maybe there is some sort of a gym subscription or co-working space. All of these as well can easily get debt on their books by simply leveraging the existing cash flows that are there.
Got it. Perfect. That is very, very helpful. Great to understand those examples as well. And reoccurring revenue is a different paradigm and very helpful. So I think just summarizing the discussion so far, right? So it's really not a either or between debt and equity, right? It's basically the right mix of both these asset classes to kind of drive growth better for the companies. So maybe if you want to talk about some best practices, and maybe you can take some examples as well, take a journey of a company and see, at what stage, what are the use cases for applying debt or equity, like you just said, right? Or any form of the alternative financing instrument. So maybe you want to double click on this part, on the application part of
Absolutely.
the finances. Yeah.
Most definitely, Shrikant. I think again a very relevant question, and just to sort of re-emphasize on the statement that you just made, it is definitely not debt or equity. It is debt with equity or equity with debt at any possible time. We at Recur ourselves, most of the folks come from the equity background and are very big advocates of equity because at a point of time in the company's life cycle, you don't really need a percentage of your top line. You need a multiple of your top line or a multiple of your revenue to be able to maybe scale for example geographical expansion. It all comes down to what exactly is your go to market strategy while you are entering into a phase of your company's growth. Keeping all of this in mind, I know it sounds slightly repetitive, but end use case of capital, I can't keep it is the most important point for me to keep emphasizing in this particular discussion. Why is it that I'm taking this capital? Why is it that I want to dilute my equity to raise money? What do I plan to do with this equity that I have diluted and this money that I have raised? So at any point of time, depending, if I'll take again the company life cycle that we were discussing thus far, if I am in very early stage of my journey, and this is very similar for the kind of journey that Recur went through as well, where I'm still finding my product market fit, where I'm still finding my next paying customer, even if I have one paying customer today, I need the ability to experiment and hence plugging that with equity because the risk is also multifold. An investor or a shareholder who's coming and sitting on your company's cap table is looking for long-term growth in his wealth via capital gains. Hence, he wants your company to be fundamentally working towards the right metrics. That is the kind of risk that an equity investor is taking to get equity-like returns. So very helpful in early stage of your journey. You have the right TAM identified, you have the right team with you so that you are an attractive bet for equity because that's the kind of risk that they are taking. However, as you move forward, as you have been able to sort of pivot into multiple ways, figure out what exactly is it that you're solving for in the market, and you want to double down on one core competency, which is going to be the primary product or service that you sell and scale your business around. That is where debt becomes a complementary asset class to equity, or can simply be for a bootstrapped company, for example, right? I know that I'm always talking about equity, but even for a bootstrapped company, where for a matter of fact, a cash profitable bootstrapped company was using its profit and keep rotating it in the business, has the ability to take more debt and simply utilize that debt to take certain experimentative bets because they know that there is some amount of cash already coming into the business. So it depends on what stage of my journey in. And in this particular example, if I was very early, I would look at equity as an asset class. If I have stable cash flows, which is slightly later in my company lifestyle, I will always look at debt. But in the next phase, where it becomes that I have a product market fit, where I'm now looking to obtain even more customers, I will use a mix of debt and equity. And the reason I will use a mix of debt and equity is because equity is very important for a founder. You need to have control on your company to be able to take the decision. Now, if I am credit worthy, I don't really want to dilute to lose control on my company or lose control of my decision making, things which are very prevalent in the VC ecosystem that we see today. So that's where utilizing debt and equity together becomes an absolute power packed way to supercharge your growth.
Perfect. No, it makes sense. And you also highlighted about bootstrapped companies. So I just wanted to clarify this. You did take example where, even bootstrap companies, as they become profitable, of course, they by definition, they become profitable much earlier, in some sense. They can also leverage that. But in case of Recur, where do you see your customers, is at the startup once they have raised equity is when they become more relevant for you to take up debt, or it's also the other way where, there are a lot of bootstrap companies whom you would, offer, and then maybe then they become ready for equity. What are you seeing in the market? Yeah.
So, Srikant, in the market, what happens is when there is an institutional VC that comes and sits on a company's cap table, it adds a sense of discipline in their way of working in terms of reporting of numbers, in terms of creation of an MIS, in terms of being wary about their cash outflow in the business. And that is what a VC funded company is capable of doing because, well, that's the way of operating when you have been able to dilute or been able to raise from an institutional VC. Now, that sense of discipline, sometimes we have seen is missing in a bootstrapped company, and hence vintage of a company. Since how long has it really been in existence? For how long has it been able to sustain? Why has it been bootstrapped? Like, what exactly are the enterprise or the SME nature of customers that they are servicing comes into the picture. So, yes, at any point of time, a bootstrapped company with a good vintage, a strong balance sheet is a very attractive proposition for debt. But the aspects slightly change around how are they really managing their cash, and if the cash is coming in and out of the business, where is it being utilized? otherwise. The diligence is slightly different, but the end use case is very relevant for a bootstrapped company, or for that matter, a VC funded company. Just the underwriting or the credit lens can change slightly.
Got it. Got it. And we spoke about the criteria. I'm just touching back on that, and also we looked at some of the use cases you just mentioned. So, but anything else you would like to add from a criteria point of view? Because again, the ubiquitous fact is that every founder I speak to, they would have gone to the bank next door and they would have got a rejection from the bank, saying, you're not proper. So what differentiates you in that sense, and how do you approach helping early stage founders and startups?
Yeah. Yeah, Shrikant, I know that this is somewhere during this part of this discussion, this is going to come up, where differentiating between debt products will come into the picture. Now, if maybe, and I will keep the detailed explanation towards later, but currently there are various kind of debt products that really exist in the market, right? There are traditional term loans, there's invoice discounting, there's PO financing, there's revenue-based financing, there's subscription-based financing, there's venture debt, multiple aspects which we could discuss on further. So it actually matters on what kind of debt am I really availing by leveraging what kind of a security, collateral, or asset. Now, if I'm walking to a bank has a very different mentality or a very different way of underwriting credit, where they still want 3 year of profitability, 3 year of a balance sheet. They still believe in collateral because that's the natural way of working. Hence, we need to be aware that what is the new age way of financing that is available for early stage founders. And other than just collaterals and securities, there are cash flow streams, there are revenue streams, there are POs, there are invoices that they can actually leverage to be able to get debt. In terms of criteria, I'll first speak about the criteria that we have at Recur, which I have touched upon earlier, but just to re-specify for the benefit of everybody, because we work as a facilitator. We are not a balance sheet lender. We work as a
Right.
facilitator where a company or founder management team can not just come and discover their eligibility to raise debt, but they also have the ability to discover debt products that fit their identified use case. Now, in this particular case, the only three things that we really look for and we have seen work very well for us, it's all about facilitating capital. So we can help you raise capital if the company vintage is of a year. Having said that, even lower company vintages can raise debt, just that again the product changes slightly. There needs to be a cash runway position of about 3 months or more, and at any point of time their concentration on a single cash flow stream cannot be above 50%, which means that you need to have at least a minimum of 3 to 4 to 5 paying customers so that you can actually leverage one of these cash flow streams to raise debt. This is what the general criteria of qualification is for companies on our platform. But other than that, if there is a company or any of our listeners who don't meet these criteria, but for example have an invoice from an enterprise customer, they can simply walk up to a bank which can offer them an invoice discounting facility. So based on different debt products, the eligibility can change, but I'll be very happy to maybe deep dive a little bit more here or circulate something, Shrikant, for the audience, that what kind of
Sure.
eligibility for what debt product is available in the market.
Sure. And actually, I have a follow-on question on this itself. But like you mentioned, if anyone wishes to reach out to us, we'll share our coordinates, or you can reach out to us on LinkedIn, and we can definitely find way to pass on presentations or any information on these matters. But Amar, you touched upon venture debt, and we also hear, and initially I actually also confused you guys for revenue-based financing. Now that's a new asset class also, right? So if you want to just decode, venture debt that you guys do and revenue-based financing as well, that will be helpful for even for our
Yeah.
audience. Yeah.
Yeah, most definitely. I've realized that debt actually is a slightly translucent instrument. That's why it requires so much decoding. So very
Right.
happy, Shrikant, to be able to sort of differentiate very quickly and crisply across these instruments. Yeah, the first one that you picked was venture debt. It sort
Right.
of gives away in the name only. Venture debt is very similar to how venture equity behaves. Venture debt will only come into a company where they already have venture equity, because that's the way of qualification, or for that matter some sort of filtration criteria for them, which means that the end use case that a venture debt solves for is very different. It is that you have already raised equity, and to extend your runway maybe you need to plug it in with the venture debt, and that is where venture debt becomes a extremely low on accessibility front for early to mid to non equity raised founders. So that's where venture
Right.
debt really comes in and step. It will always come and follow venture equity, and because it follows venture equity and has a very similar way of behaving, it is not flexible or for that matter extremely fast. It is great because it gives you the ability to repay debt over a long period of time and comes with its own constraints that I've already discussed. The other one that you mentioned, Shrikant, was revenue-based financing. Now, revenue-based financing is also, I mean, in all likelihood, it's a good product that existed, but it comes with its slight fallacies. And that is where we decided to pivot away from revenue-based financing. At any point of time when you're working with a company or a founder that is taking debt, you don't want to penalize them to grow too fast. You do not want to penalize them just because they are growing very fast to pay you back quicker. And that is where revenue-based financing, while it comes as debt on your books, actually services its debt via the revenue coming in from a company. So to put things into perspective, if I have taken revenue based financing and in the next month I grow maybe from 10% to 30%, then I pay back linked to the 30% that I have earned, which is my revenue, which means that my cost of capital effectively becomes way higher. That is where we decided to, obviously, as a platform, slightly pivot away from RBF venture debt.
Hmm.
Sales invoice discounting is another product that I specifically just touched base on, and
Right.
I'll be very happy to talk about. In this particular case, the credit underwriting or the risk changes, right? We are not evaluating a borrower anymore, but we are evaluating the credit worthiness of the end customer that they have serviced, because now the
Correct.
obligation to repay is on the end customer. So for the benefit of the audience, if you have an enterprise customer where there is an invoice amount which is due to you, or maybe the credit period that you receive this money from is 60 days, 90 days, invoice discounting can really work, because the enterprise nature or the enterprise customer on the other end actually has a credit rating which you can leverage to be able to get invoice discounting from banks. We ourselves do this, and we have generally advised companies to do sales invoice discounting when such a filtration criteria they can meet, which is an enterprise nature of a customer, credit period of over 60 odd days. And then, I mean, it comes again with its bells and whistles, not to deep dive and make this into a sales invoice discounting call. Yeah. The
Right.
other, I mean, there are various other products also which behave very similar, which is supply chain financing, asset financing. I think asset financing is one important for us to consider, because it takes care of certain traditional companies which are asset heavy. I mean, if I have a lot of assets that I have on my book, then maybe I can look at leveraging that as a collateral, or maybe letting
Hmm.
some other entity buy these assets on my behalf and then buy them back on a depreciated value. So there are various debt
Correct.
instruments that are like this that are there in the market which are prevalent.
Perfect. I think thanks a lot. This is super helpful, and I think you kind of decoded it quite well, and where each of them, and I mean every instrument I think has its own use case and applicability. So I think it's for the founders to ascertain what works for them. I think and one caveat in venture debt, not really caveat, is I think there's also a form of equity in linked, right? I've heard where venture debt players also have a small amount of equity, or maybe have some
Oh,
warrants
most
or some
definitely.
optionality. Yeah. Okay.
Most
Yeah. So
definitely. I think that is one of the sort of, where you read advertisements and they read, please read the fine lines carefully. So that's where you have to be very, very careful about the fine lines when you're obtaining or availing a venture debt product. Because while a venture debt product sounds like debt, it actually has a play like equity where your share warrants or your equity warrants get attached to it. And hence, while it comes as traditional or looks like traditional debt, it has a kicker of an equity warrant or a share warrant attached, and that becomes eventually dilution for you. So it's not a pure plain non-dilutive debt product. It is a
right.
dilutive debt product, slightly different from the other products that we discussed, which are purely non-dilutive.
Got it, got it. And yeah, I mean, it's. I think everyone should go into the fine print. Of course, they're there for the various reasons, and maybe the risk the venture debt players are also taking up. And obviously, they might convert, or the warrants can be exercised, and that's where the dilutive element can come in. Again, what criteria or what factors can lead to that is something I think the agreements need to be well read, well understood before you go into it. Perfect. I think this is super helpful, very educational for me as well. One question I have more is on the, and this is something very relevant, and I think this is not just a debt related question. I think in general, I think we are hearing a lot of companies coming into the question because of various governance and controls, a lot of financial control issues as well, right? And the moment you talk of debt, I think a different DNA is needed, I think, right? And early days, it's a hustle mindset, and it's all equity DNA, let's experiment and all of that. But when someone actually takes debt for the first time, they need to kind of shift their systems, processes to kind of now be in the mindset of servicing them. Not servicing them is actually a big issue, right? That comes, and we are already seeing examples of that, right? So any tips, and what have you seen in these journeys? Because you are at the cusp of companies moving from only equity to, let's say, taking up debt and then building the system. And like you said, in a way you are servicing customers who eventually will become customers of the banks, and kind of getting them into that zone. So what are some best practices that you would like to share from how should companies internally govern themselves better before taking debt?
Second, I think this is where I'll, for the first sort of aspect of this entire discussion, use Hindi, because in most of the aspect, most of the discussions where we're sitting with founders across the table, they say कि यार मुझे इतना ही पैसा चाहिए. I want X amount of money to hit my balance sheet. And the most frequent question that we ask them back is क्यों चाहिए आपको ये पैसा? Right? क्यों चाहिए इतना पैसा for that matter? It is easy for us to say कि मुझे आज 1 करोड़ रुपए चाहिए, but we forget to sort of understand, and this is what you've already sort of touched base on while you were introducing this question, that there needs to be enough discipline to be able to repay 1 crore 10 lakhs with the company's revenue or EBITDA margins, or for that matter, simply customer acquisition or customers that will pay you in the future. So the most important aspect that I would want to share with the entire ecosystem is that it's not about taking 1 crore today. It is about the serviceability of 1 crore, 10 lakhs, or whatever this hypothetical number could be over a particular tenure or over a particular time period. Now, the best part is, Shrikant, and this is something where I believe debt actually has an upper hand from equity. If there is decent credit worthiness, and if there is a track record which a borrower or a founder or a company have shown previously, they will always be more attractive for debt, and they will see that the tax and turnaround times for availing debt keep reducing. Platforms like ours are very helpful for this, which completely takes away the equity fundraise timeline away from it. So it's very important that while we take debt today, it is important that we are not entering into a vicious cycle of debt. This is something that I would want everyone to be very aware of, that at no point of time over leveraging your balance sheet is a good idea, because over a period of time you will take more debt to pay off the previous debt, which all enters into a vicious cycle. It is extremely important, if you're raising capital, especially debt, you are very aware of what your EMI repayments, or for that matter your serviceability of this debt really looks like. Only then, with all these prudent aspects in mind, and this is again, I mean, it just sounds tougher. Actually, debt is a very simple instrument to unravel and use. If I can generate, like I mentioned, X amount of money in a particular payback time period that I have looked at in an identified use case, I should be utilizing debt. And that is where we come in as form of advisors, and our platform really steps in.
Got it. And of course, in terms of systems and processes, I would say, they should be able to have, like tools, etc., where the predictability gets reflected, right? In terms of your revenues are booked formally, and and I'm sure you do it as part of your due diligence as well, where you ascertain, and yeah, so that's also like the quick shift from, doing a small hustle shop to now being a more formally set up organization to service the debt for all the reasons that you just mentioned, right?
Absolutely.
Perfect.
I think it becomes, yeah. Sorry, apologies.
Go
Just
ahead.
to complete that particular line of thought, what becomes very important, Shrikant, is that things like utilizing a simple invoicing manager becomes very important, to know what invoices have been raised versus what have been paid. Simple things like using a CRM tool, for example, to really know where is your next customer going to be obtained from, what does your pipeline really look like. If I'm taking debt today, where am I going to be utilizing that debt? All of these small little things can create that hygiene where debt can actually become a best friend rather than somebody that you should shrug away or run away from. And very simply, it also comes with being extremely prudent and frugal in the way you are utilizing and spending this money. At the end of the day, sustaining your balance sheet is what is important. Debt, equity, and all the others are just instruments that help sustain it.
Correct. No, I think very useful, and I'm sure the startups using, and perhaps you might also observe that this is also the time where people companies set up formal finance functions, and etc. I'm presuming, right? Many a times one of the founders themselves double up as a finance person, but I think now they'll set up teams and systems like you just mentioned, right? I hope that is something you observe as well.
Oh yeah, most definitely. Having a CFO in place, I would actually advise a lot of companies, in case our audience is more early stage founders that while we do believe that a CFO comes in later in your company life cycle or a little later in your journey, there are fractional CFOs that exist. There are
Right.
ecosystem partners, there are chartered accountants, there are company secretaries. It never hurts to be well prepared. That is the only way that I would
Correct.
like to put it. Having an MIS in place, which is giving you an idea of what is happening in your business, right? As a founder, you need to obsess about certain metrics. As a company owner, or rather, in any sort of management position of a company or just a part of the company, you have to be extremely data driven and obsessed about metrics. And all of this hygiene really helps you eventually utilize debt to truly unlock the power of debt.
Perfect. And the last thing I wanted to check, Amar, was you also just mentioned about the timelines, right? And that also kind of differentiates you guys, right? So, what is a typical, timeline to close financing? You would like to touch upon that?
So Shrikant, here, complete kudos to our tech and product team. We were extremely invested from day one on the product side of things, and the idea was always to build for scale. Because at any point of time, if you have to move the paradigm shift from lenders to borrowers, you need to be able to touch as many borrowers as possible. And hence, in one of the introductory lines, you mentioned fast, flexible, hassle-free.
Correct.
It all starts with fast, because at any point of time, if I need capital, I need capital now. I can't really wait for a diligence exercise to run 3 months to solve for a use case that I'm facing today. And hence, at any point of time, the technology that we have built, which integrates with a financial tool or an invoicing tool, or for that matter, a CRM of a company, which helps us avail data quicker, organize data in a manner which is consumable, present data in a manner which is consumable for credit underwriters, and then simply facilitate debt based on this particular credit enhancement and credit monitoring that is done, is what the entire journey looks like. To put things into perspective, from the first touch point to cash in bank, it could be as low as 48 hours, or at the max could be between 10 to 14 days. It all depends on the input that we are giving as data to the engine to receive the best possible output.
Got it. Perfect. I think that's very, very impressive, right? I think somebody needing capital, getting access to it so fast, will definitely change dynamics of how they want to grow with using that capital. This is wonderful. This has been very, very informative, Amar. Thanks for doing this. Any last things you want to add, or anything you missed about talking about Recur as well, to all our audience who are listening in?
I think extremely important that with the sort of advent of the new age of the kind of companies, the kind of ideas, concepts that we're coming up with, we are always aware of what's happening in the ecosystem, especially from a financing standpoint as well. Shrikant, one aspect that we work very closely with founders on is helping them create that ecosystem. As I have been stating repeatedly during this conversation, it's not about just facilitating capital; it's about utilizing this capital in the most efficient manner, because at no point of time do we want to leverage a balance sheet to make the company non-existent in the future, right? It's direct business loss for us. We would want them to be able to grow and scale so that their requirement and appetite for debt always increases. And hence, creating that ecosystem is what Recur does extremely well, where working with founders by simply helping them avail zero CAC sales, or for that matter, access to products like Capita, for example. You guys are partners with us. So if I was an early stage founder with an ESOP pool that I have just created and I'm looking to dilute or have diluted, I would love to use Capita, and founders who are using Recur can just simply get access to credits from Capita, get access to the product. And like this, we've created this entire ecosystem where people stop looking at partners who are facilitating debt as maybe DSA agents, but an entire ecosystem which comes and helps them supercharge this growth.
Perfect. Yes, I think you ended on the right note. Supercharge the growth. So it's not just debt, but also a lot of facilitating products and services that aid and enable these growth companies to become successful. I think this has been an amazing conversation, Amar. So thanks for taking time. I think we had some questions as well. So of course, I think this will continue as this video will be kind of live on our page. People can watch it at their will and reach out to us if you have further questions on this asset class. And also perhaps avail Recur services or Capita services for whatever requirements you have, either on the debt side, availing non-dilutive financing, or if you want to manage equity, of course we are always there for you as well. So on that note, Amar, thanks a lot for making time, and this was a lovely interaction. Thanks for engaging so dynamically, and thanks for answering all the questions. Right? Any last words?
No, it was an absolute pleasure. Thank you so much for having Recur and me over. Very happy to be a part of anyone's growth journey in terms of any form of sort of help that we can provide. So yeah, very happy that this happened and excited about future conversations as well.
Of course, I
So,
think the
so
conversations, as we call it, will continue, definitely this will not be the last one. So we'll definitely have more of these and maybe deep dive into more relevant topics as well in the future. Thanks, Amar, for making the time, and thanks everyone for tuning in and asking some of the questions. Look forward to more conversations. So stay tuned to our LinkedIn page. Thank you.
thank you
Bye.
everyone. Bye. Thank you.